let's go there next with our guest who's sitting with us in studio, Grant Patterson, MD at Providence Wealth. Nice to see you.
Nice to see you again. Nice to be back.
Yeah. Where do we start? I mean, inflation is a natural starting point.
Yep.
Where do you see it headed?
Well, look, I don't know. There's so many distortions in the financial markets at the moment because of the central bank policy over the number of years that it's very, very difficult to really get clarity about how this is going to unwind. I think one thing's for sure is we're going to see a lot of volatility, and we're going to see a lot of experts on inflation come out of the woodwork that we haven't probably seen for the last 30 or 40 years. Our take on it is there is real inflationary pressures in the system for sure. And any manufacturer you talk to about input prices, it's very difficult. I think wage costs are now something that might start creeping into the cost base of corporate earnings. So I think that's an issue. And of course, the dialogue is all about transitory inflation, but no one yet has given me what is the time frame of transitory. Is it 3 months, 6 months, or 12 months? I think it is likely to see sticky inflation for a while, although the bond market at the long rates is not of the view that it's going to be sustainable.
Grant, how is it going to play out? Because not a lot of people have experienced an inflationary period. I've been involved in markets about 2 decades, and I've never really seen an inflationary impulse. So there's not a lot of people out there who have seen periods like this. What's going to happen? You mentioned what's going on in the bond market. There's going to be a big adjustment if there is going to be sticky inflation. Well,
I think there are some seismic changes going on around now. For the first time, we've seen an impulse coming through inflation. We've started to see the bond markets back up in yield, I mean, we've had 40 years of declining interest rates, which have helped risk assets. So if all of a sudden we start seeing a change in rhetoric there, whether it be through slightly higher interest rates or slightly higher or elevated inflation, then I think that's going to have a big impact on the discount rate, and that will then flow through to valuations, particularly in growth assets.
So when you think in terms of asset allocation, how are you viewing equities, for example?
Well, equities, I think we're approaching equities really from a thematic basis.
Okay.
I mean, when we talk about indexes, we've got to remember that the top 10 stocks in the US account for 30% of the market, just the top 10. So if you want to try and have a view on markets, you've got to have a view on those top 10 stocks. So where we're positioning our clients' portfolios is very much having a look at thematics. We're a value manager bias. I mean, value managers are probably 3 standard deviations below growth over the last little while. We prefer active managers, so we're not chasing the big stocks all the time. And we're looking at thematics. So the thematics are decarbonisation, hydrogen, renewables, artificial intelligence, the infrastructure, global infrastructure, ESG. There's a number of thematics that are out in the marketplace. So what we're looking for is active managers who are playing those thematics, which can ride through the cycle, if you like.
What about equities from a regional perspective? You mentioned about the concentration that we've got in the US market. Is that a concern?
Yes, it is. I mean, from a valuation perspective, it is. So we're underweight the US on behalf of our clients. We still have some exposure in the US, but we prefer other markets, in particular Japan, we think looks quite interesting. So I think you've got to be a little bit careful in regards to where the valuations are. But it's really not so much an index, it's really about what sort of exposure you want. Do you want exposure in global banks, given that the interest rates are starting to rise, which should help their margins, for example?
Now, how do you look at some other asset classes, whether it be fixed income, whether it be property, alternatives? Where's the opportunity? Where's the opportunity for growth?
Well, the number one thing I think to protect and preserve capital, particularly after the very, very strong move over the last few years, if you want to protect your legacy, I think you need to be very diversified. So that is going to sort of protect the portfolios through an inflationary environment or not a deflationary environment, or through higher wage costs or global infrastructure spending. So you've got to be diversified. And so where does that all fit in for us? We've got a holding in gold, for example, to give us some protection against inflation if that becomes a problem. Alternative assets, if they're non-correlated to the risk assets, I think looks very interesting. Long-short equity funds, for example. We have an exposure in agriculture. Once again, that's a reasonable inflation protection in agriculture. It's non-correlated to the general economy.
And sorry, I think that's interesting. So are you talking about the soft commodity side of agriculture, or ag tech, or fertilizers?
Yeah, we're talking more about the actual production
yeah.
of food.
Food production.
Yeah, so that, and with tech that's coming through now in the agriculture sector, it's making it much more efficient. So the returns from the sector is likely to be better given the use of technology coming through.
Grant, what's the view on China at the moment? There's a lot of uncertainty about what's going on. We're seeing there's a slowdown in the economy for sure. There's a lot of regulatory change which is also underway. Where does that sit with you as an investor?
Well, it makes us a bit nervous. I mean, there's clearly a change of rhetoric coming out of China, both at a domestic level and at an international level. So the rhetoric on the international level is obviously, concern in regards to geopolitical tensions that's occurring and China flexing their muscles. And also domestically, there's a focus by the authorities to wind back speculation, particularly in property, which is a huge part of the economy, and to try and curtail some of the corporate, wealth that's being delivered there, because, they're very concerned about, with such a huge population and the rise of populism, they want to make sure that the wealth is shared across the population so it doesn't become an issue.
Yeah, with that in changing environment, is there any changes to the way that you invest around in China as well?
Well, look, there's been a bit of debate about whether it's investable or not at the moment, and I know that Hamish Douglas from Magellan has been talking a lot about that recently. We don't tend to invest directly in China. We leave that up to the fund managers to have a look at whether a company within China is investable and go along those lines. But I think sitting here in Australia, I mean, we've got to be conscious that China, one of our biggest trading partners, is unhappy with the Australian government and vice versa, and there's tensions there. So, how that's going to play out, and we've already seen that in iron ore, for example. I think it's something that we need to be conscious of.
China not just taking issue with Australia, but
Yes.
it's a very uncertain time right now in China relations in many respects. So, just to sort of wrap it up, Grant, we're heading toward 2022. Maybe I'm a bit early to do the call outs for next year. But you've expressed some wariness, some caution, talking about rising wages, inflation, peak everything perhaps. Is this just the dying days of this bull market for equities?
Well, I think we're very late cycle. The issue still is that there's no real alternative still. And you want to be very wary of duration risk in your bond portfolio. So that sort of takes that out of the equation a little bit. Credit spreads we think are terribly tight. You're not getting paid for the risk, so that takes that area out. Loans still look pretty interesting to us. Niche property still looks good value to us, where you're getting yields of 7 or 8%. But in regards to where we're up to in the cycle, I mean, my 40 years, speculation is pretty rife at the moment, and that's normally towards the end of the cycle, not the beginning. But I'd go back to the point again. I think it's dangerous for me and for us to talk about an index and market generally. I think it is really going to be, the next few years is going to be it's not going to be indiscriminate. You need to pick your themes, pick your sectors, pick your stocks, and don't focus so much on an index.
Is it untoward to go and have a slightly higher than usual cash balance at the moment, to go and wait for opportunities, or?
Well, we do. I mean, I know you get paid nothing for holding the cash, but the value of your cash, or the return on your cash, is once you spend it. It's not while it's sitting there, and it's taking advantage of that when there is opportunities. Now, at the moment, there is so much product, and there's so much coming out, and money is chasing this. My experience, especially back in the GFC, where we had 30% cash, being able to have that when there wasn't a lot of cash around, when there was assets, good quality assets coming onto the market, was invaluable. So I think it's hard to have a very high weighting in cash at the moment, but we're certainly overweight cash.
Such a good conversation, Grant. Thank you so much for joining us.
My pleasure.
And
Thanks for
coming
having
into
me.
the city. Grant Patterson there, joining us from Providence.